The Fibonacci sequence is a fascinating series of numbers. It's named after Leonardo of Pisa, also known as Fibonacci. This sequence follows a simple pattern. Each number is the sum of the two preceding ones. It starts like this: 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on, extending infinitely. What makes this sequence truly remarkable is its presence in various natural phenomena, from the arrangement of sunflower seeds to the spiral patterns of seashells. But what does this have to do with trading currencies? Well, in the financial markets, traders have observed that price movements often exhibit retracements and rallies that align with these Fibonacci ratios. This makes the Fibonacci sequence, especially in the form of the Fibonacci Retracement Tool, a powerful tool for technical analysis. Traders use these tools to identify potential support and resistance levels, predict price reversals, and make more informed trading decisions. In Forex trading, the Fibonacci sequence is primarily used to identify potential support and resistance levels. A support level is a price point where an asset, in this case a currency pair, is likely to find buying interest, preventing further downward movement. Conversely, a resistance level is a price point where selling pressure is expected to increase, making it difficult for the price to move higher. Traders use Fibonacci retracement levels to identify these key levels. These retracement levels are derived by taking two extreme points on a chart, such as a swing high and a swing low, and dividing the vertical distance between them by the key Fibonacci ratios. The most commonly used Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels are often marked on a trading chart as horizontal lines, creating a grid that helps traders visualize potential support and resistance zones. Most trading platforms offer a Fibonacci retracement tool that you can easily apply to your charts. To use the tool, you first need to identify a significant price swing on your chart. This could be a major upward move followed by a pullback, or a significant downward move followed by a bounce. Once you've identified the swing high and swing low, you can use the Fibonacci tool to draw lines connecting these 2 points. The tool will automatically calculate and display the key Fibonacci retracement levels: 23.6%, 38.2%, 50%, 61.8%, and 100% between these 2 points. These levels are often marked as horizontal lines on your chart, creating a grid. This grid can help you anticipate potential areas where the price might reverse or stall. Keep in mind that the Fibonacci retracement tool is just one of many tools available to traders. Section 4. Important Fibonacci levels. While all Fibonacci levels can offer potential insights, certain levels are considered more significant by traders. The 38.2% and 61.8% retracement levels are particularly noteworthy, as they often mark areas of significant support or resistance. The 50% retracement level, while not officially a Fibonacci number, is also widely watched, as it represents the midpoint of the price swing. 38.2% retracement. This level is often seen as a shallow retracement, suggesting that the pullback is relatively weak and the trend is likely to continue. 50% retracement. As the midpoint of the price swing, this level can act as both support and resistance. 61.8% retracement. This level is often seen as a deeper retracement, suggesting that the pullback is stronger and there may be a potential trend reversal. Traders often use these levels in combination with other technical indicators and chart patterns to confirm their trading decisions. Section 5. Fibonacci in action, a real trade example. Let's say you are looking at a chart of the EUR-USD currency pair. You identify a strong upward move, followed by a pullback. You apply the Fibonacci retracement tool to this swing high and swing low. You notice that the price finds support near the 38.2% retracement level and starts to move higher. This confluence of the price finding support at a key Fibonacci level could be a signal to enter a long trade, with a stop-loss order placed below the recent swing low. As the price continues to move higher, you could trail your stop-loss order upward, locking in profits as the trade progresses. Remember, this is a simplified example for illustrative purposes. Section 6. Pros and Cons, Fibonacci Addition. Like any technical indicator, the Fibonacci Retracement Tool has its pros and cons. Pros: the Fibonacci tool is relatively easy to use and can be applied to any time frame. It can be a powerful tool for identifying potential support and resistance levels, as well as for confirming trading signals from other indicators. Cons: the Fibonacci Retracement Tool is subjective, meaning that different traders may interpret the signals differently. It's also important to remember that the Fibonacci levels are not foolproof and should not be used in isolation. It's essential to use the Fibonacci tool in conjunction with other forms of analysis, such as price action, candlestick patterns, and other technical indicators.